All right, welcome back everyone. So this is going to be episode 3 where we're moving on to liquidity, session liquidity, time-based liquidity, basically same thing, and time cycles. So just all liquidity and the duration of time that it's basically most likely to show and the times that really matter too. So first off, let's just start with liquidity and let's hope to go to a new chart. Can we use NQ? Okay, we can use NQ. So what is liquidity? When I'm talking about liquidity, usually what I'm referring to is a specific high or low. So like previous all-time high is good liquidity. All-time high currently is good liquidity. Those are like the most major liquidities. So our high currently, that would be major liquidity. I usually make it green and then red for bearish liquidity. That looks black. So let's just make this lighter green. That's too light. So right there. So that's our buy side liquidity. It is abbreviated as BSL, as buy side liquidity. Why does this shit keep moving? Okay, so let's find something clearer and let's go to electronic trading hours. So liquidity is basically your highs and lows. So if I were to look at a certain range, any range, so like this range right here, what would I be doing? Since if this has not printed yet, if we go back in time, and go forward a little bit more. Right there, we have a market structure shift on the 4 hour, which would mean we have a change in the direction of price. Also because we've, hit some sort of confluence here, which we know from the future, but just talking about the high and low right here, this is our range. And we can put it as premium and discount. So premium and discount basically tells you if your liquidity is in the right position and if the liquidity is at the right time, then it's significant. But if it's also in the right position, it's also significant. So liquidity could be any swing low in discount is a take profit, which is basically a, let me look at the 1 hour. What I mean by take profit is it's a place where you can exit. It's an exit you can have. You don't always have to aim for the bottom, the very bottom, because you also might miss it and it's going to reverse and then you're going to close for, some less money. So these all right here, think of this as our range, right? We talked about these yesterday. Our range is this high, this low. So we have 50% of the range, which will determine our bullish, more likely to be bullish is up in this half, more likely to be bearish is up in this half. Since we have taken all of this sell side liquidity in our bearish range, and actually before it would be this range, because we're not even sure that we're making a range yet. So we've already taken out discount sell side liquidity, discount for value gap, liquidity. Well, discount sell side liquidity meaning just these discounted lows, right? But also we do have the fair value gap we don't need to talk about, but just these discounted lows are your target. There's one like right here, right there. So those are your target. We have taken out bearish targets, bearish sell side liquidity. So what am I looking for? I'm looking for a move to the bullish upside. Also because if you have that higher time frame change in market structure. So if I'm looking for bullish liquidity, it's right here. This is like the same thing as our reaccumulation, right? In the market maker model. Because what we're doing right here is basically we're retracing. So we're displacing, retracing, and accumulating, which creates our liquidity highs that we're then going to trade back into and create as our new targets on the way up to all-time highs. And that plays out, yeah, over time. Over time plays out. We know that because we're on replay. But that's what buy side and sell side liquidity is. It's basically the targets that you're looking for to continue the trend. And the trend is, okay, let's look on the range and see where we are above 50%, below 50%. That is the first confluence you should do, is find out where are we in the range and what liquidity have we taken. And then after you find out what liquidity have been taken, you find out what kind of liquidity, what kind of timed liquidity is that. So I'm going. All right, so we're pulling out the cheat sheet, and this is basically my trading model I made a while ago, a couple months ago, basically at the beginning of the year. I had one for last year, but I ended up adjusting it, so it turned out to be this. But it's basically very in depth. What times of the day are very, very important. Let's start with the sessions. So sessions of the day I want you to remember that are very, very important. Let's just start of Asia. Let's put this down. Start of Asia is 6 p.m. to 2:30 a.m. 6 to 2 usually is what I do. 6 to 2. Oh, I could even pull it up here. Asia. 6 to, what is that? Yeah, it's 6 to 2. I don't even keep Asia on because I don't trade Asia. But Asia session, if we're looking for, okay, in the previous day, what am I looking for? Where do we open? Midnight open. Asia is way before that. 6. So our low from 6. Okay, wait. Because this is how it works. Our low from 6 to 2 is our Asia low. Our high from 6 to 2 when we open versus where we close is Asia high. There. And then we have the same thing for London. 5 to 7. Then we have New York pre-market, which is 7 to 9:30. Right? The high and low from 7 to open, initial high and low. And then we get into the New York AM and PM. So, let me just mark out New York. Actually, we don't need to mark that out. Because what we do need to mark it out. Because there are a lot of different types of liquidity, right? So this gets very kind of intricate very quickly, and then let's mark 1:30 because that is the start of the afternoon session right there. You can see it right there, PM. And you can also see that is the cleanest price delivery. This is kind of pre-afternoon, and then right here we have afternoon session. That ends at 2:30, or sorry, ends at 4 afternoon. First macro is in that 2:30 range. Okay, so these are the time intervals in day which I'm looking to take trades during. So this one right here, 1, 2, 3, 4. Basically 3 of them in the three of them specifically, I'm looking at Asia, how it delivered, but really I'm not trading it. But I'm using it as, my highs and lows. So if we're just marking like our highs and lows, this one probably isn't going to make too much sense. I mean, you'll see like, okay, we swept Asia high. Create SMT, regular trading hours. Relative equal highs. Oh my God, I'm tweaking. Relative equal highs. We swept this in London, right? Because we're in London right now, so we have this London low. So you can see Asia high is created, Asia low is created, edge Asia high, making it more of a high to retrace to because we have relative highs now. And then that's just more liquidity, basically meaning more money is resting here, so we'll want to take that. Plus we have all-time highs right up here. Then we sweep, we retrace, displace lower, and this is in London, right? This is in London. So we're displacing lower in London. So, okay, that's not showing up because I'm not on the 15. Right, so we're displacing in London. We're retracing up. Now we're displacing again in the pre-market. So we have our initial high and low, which is 7 to 8:30. So, 7 to 9:30. Initial high and low. Right there. and there. So in every session, what I'm doing is I'm not always marking out all of these highs and lows, but you can see these are very important levels when even on a day like today where it's like kind of goofy and all the PA that was going on, you can see that okay, I could have taken a long here after we created a market structure shift after sweeping out Asia low and we have relative highs. I could have taken a long like right here. Somewhere it's probably like a 5 minute or 15-minute retrace. 15-minute retrace into a 5-minute gap right there. You have your stop below. This is like just a trade you could have taken, right? Just because this is like a perfect market maker model. It's just in a different session. Why are you doing that, bro? Bro. Let me drag this SL, bro. Like right there. Why is this so extended, bro? 200-point target. It's like right there, 125 points. That's like a 1 to 4. If we put our stop at the bottom right there, that is a, why does it not say 1 to, okay, regular trading hours. 1 to 3. If you put it at the bottom, if you are a little less risk on, it'd be 1 to 6, like something like that. But you see marking out these liquidity, like literally right to that bottom, we retrace high, we have relative highs, we sweep that right when we open New York. Initial high, initial low, we go right to initial high, move, then we displace lower, take initial low, and right through that take also London low. And that is during where? That is during 9:30 to 11:30. That is the AM. PM is 1:30 to the rest of the market ending 4. And then in between then, we're just kind of chilling, you know? I'm not really trading between 11:30 and 1:30 because personally, that's lunch. That's bank lunch. That is New York lunch. That's when they're not doing too much or they're reversing the market or it's just less likely of a condition as opposed to after 1:30. Right after 1:30 is very important. So after talking about that, you know what liquidity is, right? We know the session liquidity. You know the times to look for those highs and lows, which are, right, liquidity. And now once you look for those highs and lows and you mark them out like we did for today, you get an understanding of where the highs and lows of price are going to deliver to. And so time-based liquidity with those time intervals where it shows you the specific highs and lows is just giving you, think of it like a microphone, or not a microphone, think of it like a magnifying glass to the market, right? All these confluences, all these things you're adding on are really just to magnify price and figure out where it's going in the simplest direction, right? You're putting the microphone, bro, why am I saying microphone? You're putting the magnifying glass up, you're really seeing price, and you know which highs and lows it's going to go to. You have them marked out. That's what liquidity, time-based liquidity is made for. So liquidity, done and over with. You know what liquidity is. We don't even need to look at multiple days. It's the same day. Sometimes liquidity is swept in earlier sessions, and usually London and New York AM is the perfect. London initial high and low and New York AM are the 3 liquidities that I look for most often. And if our Asia range is really low, what I'm looking for is the liquidity at Asia low. If the daily is very close, what I'm looking for is a previous daily low, previous daily high, and the same thing for the week. Previous weekly low, previous weekly high. And when we get close to a month, previous monthly high, previous monthly low. But those are the liquidities, mostly daily and weekly, and then intraday, the time range that I said. Those are the liquidity points that I would actually use, right? Especially previous day high. Previous day high and low are very, very important. Talked about session liquidity. You understand what Asia session is, London session. You understand New York lunch, which is that 2-hour window between, or like 3-hour, 4-hour, between 11:30 and 1:30, and 11:50 is when we get our last macro, the AM. That isn't technically lunch-ish, so you could trade that. I usually am just off and I wait for price to do whatever it wants because it's slower movement. You see, it's just slower movement. So that is it for liquidity. Hope that was helpful. I bet liquidity is probably the easiest concept to understand, right? I mean, we're just looking at highs, lows, highs, lows. Is it premium or discount liquidity? Meaning, is it buy side or sell side? Well, I don't know. Is it on the high or is it on the low? And then you're also looking at if it's premium or discount liquidity in the range. Okay, we're looking at is it above or below 50% of the range? Because above is buy side, below is sell side. Like that kind of thing, bro. I mean, not even all buy side, or not even. This is sell side, and that's still above 50% of the range. But I'm just saying, like the like I said, the most prominent ones are below 50% of the range because we have to reach a discount. We have to reach a discount to then go to a premium, and we have to go to a premium to then sell off to have a discount. And that's how price works, right? We're bouncing around. It's like a tennis match, but nobody's. It's an infinite tennis match, infinite badminton match. Nobody's winning, and we're only trading. That's literally what trading the market is like. We're only trading, and retail only loses, and we're not even winning. We're not even winning the game. We're just playing it, and everyone's losing. But for the very few that do get this, they will not lose. They will be the winners. Okay, so that is liquidity. I kind of went on. No, I didn't. I stayed pretty on topic. I stayed on topic. Now, what I'm gonna do, I'm actually gonna make this a double video because I don't think we've gone too far over. 17 minutes. You know what? We'll do it in the next video. This is a very kind of complex-ish topic. So that'll be it. Hope you understand liquidity, time-based liquidity, and then we're going to get to time cycles next because we're going to do that right now, actually. Because time-based liquidity is a jump off to time cycles. So time-based liquidity is such liquidity and just liquidity in general. You understand what it is. Liquidity is money. We're talking about money. We're in the money game. Money. So we got to be thinking about money. And so one thing that I want you to always keep in your head is if we're thinking about trading against retail, which we usually do, not because it generates more money, because retail has fuck all, right? They don't have any money that the big actual institutions really want. So what are they doing? They're just kind of fucking with everyone while they're, making their transactions. So highest time frame, what position would have the most money right now? And then opposite to that, what would happen and what is lining up in the charts if it's going to reverse? So like thinking, where's the most liquidity and how do I liquidate most of the positions currently in the market? Those two things is thinking like a liquidity provider, is thinking like the bank. Not thinking like retail, not, oh, we just broke this high, let's buy out higher. No, 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 no. A lot of people lost money. A lot of people lost money on that thought. Let's buy higher. They got money. Okay, so right, think about this. Broke a high. We're gonna go higher. People are buying. People are buying. Broke a high. Go higher. They would be right. You would be right if you were doing it from September 2nd to October 25th. You would be right. But then there's come a day when you were wrong. Very wrong. Very, very, very wrong. And even then, right? You on the lower time frame, still you have to hold your positions for days and days. If you're not intraday trading, which is honestly prime, I think, unless you're doing like a few trades a year, catch a few of these a year, like a couple weekly longs, couple mostly weekly longs and monthly short here, something like that. Those are the kind of swing trades that I'm going to be doing because that is really all I have the stomach for. I don't want to be taking multiple trades, futures here, options here, forex here, gold there, watches there. Like I don't want to be trading all that shit, bro. NQ and ES only, and then the rest is just like extra icing that I don't need to figure out. Well, I don't need to practice it because NQ and ES is really all you need. That's what I prefer, and that's what I'm going to trade. So let's end the video. We're going to move on to time cycles, and I'll see you in the fourth video.